Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Steve, let's kick things off with some interesting news coming out of Mississauga. The city experienced a notable surge in homebuyer activity last month. According to Zucasa's analysis of the Toronto Regional Real Estate Board data, sales in October climbed by 11.2% month over month. That's quite a jump, don't you think?
Absolutely, Sandy. It's intriguing because while sales went up, the average selling price remained almost unchanged, dipping just 0.2% to $968,036. It seems like there's a healthy amount of activity without the prices skyrocketing, which could be appealing to buyers.
Right. And what's interesting is that this marks the second consecutive month of sales gains in Mississauga. So, it seems like there's sustained interest. However, despite the sales surge, new listings fell by 17.6% from September, and active listings declined by 8.1%.
Yes, and that suggests the market conditions are staying relatively balanced. The months of inventory have inched up slightly from 4.8 to 5.0, and homes are spending an average of 52 days on the market, which is consistent with the previous month. It's a bit of a mixed bag, but overall, it seems like a stable market environment.
The standout performers were detached properties, with sales jumping 19.9% to 223 transactions. However, the average price for these homes slipped by 1.6% to $1,359,014. It's a bit of a surprise to see such a significant increase in sales while prices slightly decline, wouldn't you say?
Indeed, it's a bit counterintuitive, but it could indicate that buyers are finding value in the market. The new listings for detached homes were down 18.7%, and these properties spent an average of 29 days on the market, slightly more than in September. It's interesting to see the dynamics at play here.
Semi-detached homes also saw strong growth, with sales up 18.2% month over month. Prices edged down 4.8% to $911,974, and new listings declined by 11.7% to 158 homes. What's impressive is that these properties sold the fastest among all housing types, spending just 22 days on the market.
And for apartment condos and townhouses, both recorded higher sales, rising 8.3% and 5% respectively. However, apartment condo prices saw the steepest monthly decline, falling 5.7% to $530,793. Meanwhile, townhouse prices were nearly flat, down just 0.2% to $939,024.
Condo townhouses were the only segment to see a sales decline, with transactions falling 8.5% to 86. The average price also decreased by 2.3% to $733,475. However, these properties sold more quickly than last month, with average days on market dropping sharply from 39 to 33.
The overall average selling price across the region of Peel rose slightly from last month, increasing by 0.6% to $965,359. Across the Greater Toronto Area, the composite benchmark was down by 5% year-over-year in October 2025. The average selling price, at $1,054,372, was also down by 7.2% compared to October 2024.
It seems like for those who can afford it, it might be a good time to buy a home. According to Toronto Regional Real Estate Board President Alexia Barry-Spruill, buyers who are confident in their employment situation and ability to make their mortgage payments over the long term are benefiting from affordable housing market conditions relative to the past few years.
However, many intending home buyers remain on the sidelines due to uncertainty about their economic future. It's a time of mixed signals, but for those with confidence and stability, there could be opportunities in this market.
Let's shift our focus to the broader Greater Toronto Area, where the housing market has seen a dip in sales. According to the Toronto Regional Real Estate Board, home sales fell by 9.5% year over year in October, totaling 6,138 transactions. Steve, what's your take on this trend?
It's an interesting situation, Sandy. On one hand, buyers are benefiting from lower prices and softer mortgage rates, but on the other hand, many are still hesitant to jump in due to the ongoing economic uncertainty. It seems like a classic case of opportunity versus risk.
Exactly. TRREB President Alekia Barry Sproul mentioned that buyers who are confident in their employment situation and ability to make mortgage payments are finding the current market conditions more affordable compared to the past few years. However, the economic uncertainty is keeping a lot of potential buyers on the sidelines.
The data supports that, Sandy. New listings rose by 2.7% to 16,069, and active listings surged by 17.2%, reaching 27,808. This increase in inventory gives buyers more choice and negotiating power, which is a positive aspect for those who are ready and willing to buy.
Yet the average selling price dropped by 7.2% year over year to $1,054,372. Detached homes saw an even larger decline, down 7.3% to $1,355,506, while condo apartments averaged $660,208, a 4.7% decrease. It seems like affordability is improving, but buyer confidence isn't quite there yet.
Jason Mercer, TREB's chief information officer, pointed out that the monthly mortgage payment for an average priced home in the GTA is trending lower, thanks to both decreased borrowing costs and selling prices. This theoretically opens up the market to more buyers, but the broader economic picture is still causing hesitation.
Canada's economy did take a hit, with the gross domestic product contracting by 0.3% in August, which was a sharper decline than economists had anticipated. The TRREB CEO, John DeMichele, emphasized the need for innovation and private capital to accelerate new construction and rebuild confidence in the housing market.
That's right, Sandy. DeMichele also mentioned that governments could play a role by modernizing tax rules and cutting buyer costs to help end exclusionary zoning. These moves could potentially create jobs and deliver the homes Ontarians need, but it's a complex issue that requires coordinated efforts.
The sales to new listings ratio in October was around 38%, which is below the 50% threshold that usually signals a balanced market. With months of inventory climbing to 4.7, the market seems to be tilting in favor of buyers, yet the overall momentum remains subdued until economic confidence returns.
Exactly, Sandy. The Bank of Canada's overnight rate holding at 4.7% and inflation in Toronto at 2.3% in September are also factors influencing buyer sentiment. So, while there are opportunities for well qualified buyers, the broader market will likely stay in this holding pattern until we see some economic clarity.
Let's turn our attention to the Waterloo Region, where home prices have recently experienced a decline. According to a report by Natasha O'Neill, the region saw a 5.6% drop in the average sale price across all housing types in October compared to the same month last year. That's a significant decrease, Steve, especially when considering the broader market trends we've been discussing.
It certainly is, Sandy. The report from the Cornerstone Association of Realtors highlights that home sales in the Waterloo region slowed down by 6.7% year over year. It's fascinating because, despite the slowdown, there were actually more listings available than usual. This could be providing buyers with a wider range of options, especially with borrowing costs beginning to ease.
That's an interesting point, Steve. Crystal Moura, the spokesperson for the Cornerstone Regional Market, mentioned that the increase in listings gives buyers a chance to explore more options. With the Bank of Canada recently cutting its key rate to 2.25%, there's a sense that borrowing costs might stabilize, which could encourage more buyer activity.
Absolutely, Sandy. The Bank of Canada's governor, Tiff Macklem, indicated that the policy rate is at a level intended to keep inflation close to the bank's target while supporting the economy. This might give potential buyers in Waterloo Region some confidence, as Moore suggested that the rate cuts hint at stability in the near future.
The data shows that detached homes made up the majority of sales last month, although there was a decrease in sales compared to the previous year. Townhouses and condos followed in sales numbers. It's notable that, even with more listings, the total number of homes sold was down by 18.4% from the same month a decade ago.
That's right. And we saw a total of 569 houses sold, according to the multiple listing service. The increase in new listings, totaling 1,236 last month, suggests that sellers are still active in the market, perhaps trying to capitalize on the easing borrowing costs. However, the overall momentum in sales activity seems to be lagging behind historical averages.
It's a complex scenario, Steve. While sales activity did pick up compared to September, it's clear that the market is experiencing a bit of a slowdown. The mix of increased inventory and easing rates could create opportunities for buyers, but economic uncertainties still loom large.
Exactly, Sandy. As we've seen in other regions, the broader economic environment plays a critical role in influencing buyer sentiment. While the Bank of Canada's actions aim to support the economy, the real impact will depend on how these changes align with economic expectations and consumer confidence.
The recent TD survey reveals a significant shift in how Canadians are approaching their financial planning as they prepare for potentially higher mortgage rates. Nearly half of Canadian homeowners who are up for mortgage renewal in the next year anticipate having to make larger monthly payments. This anticipation is tied to the fact that many of the mortgages due for renewal were taken during the pandemic when interest rates were at historic lows.
That's right, Sandy. The survey indicates that about 22% of Canadians will be renewing their mortgages within the next 12 months. And with approximately 60% of all outstanding Canadian mortgages set to renew in 2025 or 2026, it's clear that many homeowners are bracing for changes in their financial commitments.
And it's not just about the numbers, Steve. The expectation of higher rates is really affecting how people are managing their budgets. According to the survey, 73% of those polled are planning to cut back on expenses to ensure they can meet their mortgage payments. It's a significant lifestyle adjustment for many.
Yes, and with 43% considering putting off home renovations, it shows how these financial pressures are impacting day-to-day decisions. It's a prudent move, especially since Statistics Canada has reported that renovation costs have increased in most parts of Canada, although Ontario has seen a slight decrease in these costs.
It's fascinating to see the varied responses to these challenges. Some Canadians, around 29%, are even contemplating selling their current homes to downsize. Others are thinking about relocating to more affordable neighborhoods or sharing their homes with roommates, each at about 15%.
Patrick Smith from TD highlights the underlying concerns about the cost of housing. While home prices have softened in certain markets, they're still perceived as high by many. This perception leads 55% of potential buyers to cut back on unnecessary expenses as they prepare to enter the housing market.
That's a good point, Steve. The TD survey also shows that 31% of prospective buyers are considering cashing in on their investments in tax-free savings accounts, registered retirement savings plans, and first home savings accounts to fund their home purchases. It's a clear indication of the financial balancing act many Canadians are performing.
The choice between fixed and variable rate mortgages is another critical aspect. Interestingly, three-quarters of the surveyed Canadians are leaning towards fixed-rate mortgages for the security and predictability they offer, despite the potential savings of a variable rate.
Absolutely, Steve. Patrick Smith from TD mentions that fixed rates might be more suitable for first-time buyers or families with tight budgets due to their stability, whereas variable rates could be more appealing to those who prioritize flexibility, like those nearing retirement.
Despite the complexities of the home buying process, only 35% of those surveyed have sought professional advice. Yet 39% mentioned that having quick access to advice would boost their confidence in making purchase decisions. It highlights a gap in the support system for homeowners and prospective buyers.
Indeed, the need for informed advice is crucial, especially in times of economic uncertainty. As Patrick Smith suggests, having access to tailored advice can help ease the stress of these financial decisions, allowing Canadians to navigate their mortgage renewals and home purchases with greater confidence. In a significant move, the Bank of Canada has announced the elimination of approximately 225 positions, which amounts to nearly 10% of its workforce, by June 2026. This decision is part of a broader government initiative to reduce public spending and brace for economic uncertainties, particularly those stemming from trade tensions with the United States.
That's right, Sandy. The cuts follow Prime Minister Mark Carney's directive for a 15% budget reduction across federal agencies. The government aims to save 60 billion Canadian dollars over 5 years, primarily through attrition and reducing about 40,000 federal jobs.
A spokesperson for the Bank of Canada mentioned that these reductions would affect all departments. The approach begins with addressing vacancies, attrition, and voluntary retirements, with the expectation to further reduce staffing levels by 225 positions by June next year. Next,
Paul Battercher, another spokesperson for the Bank of Canada, emphasized that the bank is committed to achieving a 15% budget reduction over the 2026 to 2028 period. Despite these cuts, the bank assures that it will continue to fulfill its mandate for Canadians.
the Bank of Canada has seen its workforce increase significantly since the pandemic, with numbers rising from around 1,800 in 2019 to 2,350 by the end of 2023. The current cuts are part of a fiscal review unveiled in Budget 2025 by Finance Minister François-Philippe Champagne, which also includes shrinking the public service and trimming several programs.
This budget is being described as a generational plan to build Canada strong, with 280 billion Canadian dollars allocated to infrastructure, competitiveness, and housing. However, it's not without controversy. The Large Urban Centre Alliance has warned that Budget 2025 could exacerbate the sector's crisis and potentially put 100,000 jobs at risk.
The economic backdrop is challenging, with Canada's budget deficit projected to reach 78.3 billion Canadian dollars, up from 42.2 billion last December. Trade tensions with the United States have led to steep tariffs on Canadian exports, causing Ottawa to announce 141 billion Canadian dollars in stimulus spending to mitigate the impact.
In response to these economic pressures, the Bank of Canada recently lowered its policy rate from 2.50% to 2.25%, citing structural damage to the economy due to U.S. trade actions. Additionally, the bank is now tasked with new regulatory responsibilities, including overseeing the upcoming Consumer-Driven Banking Act, which addresses the evolving fintech sector.
It's a complex and evolving situation, Steve. The bank's efforts to balance fiscal responsibility with economic growth are crucial, especially given the current economic headwinds. We'll continue to monitor these developments closely as they unfold.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.